If you have an LLC or you're thinking about setting one up and you're wondering how to pay yourself, there's a very good chance you've already heard some bad advice on the internet. A lot of business owners think the moment they form an LLC, they unlock some secret tax benefit. They didn't. They filed paperwork. And that paperwork may be useful, but by itself, it doesn't magically save you money on your taxes. That misunderstanding causes a lot of confusion, and in some cases, it causes people to make expensive mistakes. So in this video, I want to clear this up. I'm going to walk you through how to actually pay yourself from an LLC, what most people get wrong, and when an S-corporation starts to matter, and how to know whether you're overcomplicating this or leaving money on the table. Because for a lot of business owners, this is not just a technical question, this is a cash flow question. This is a tax planning question. This is a, how do I stop doing dumb things because somebody on the internet sounded confident question. So let's start with the first big misconception. An LLC does not automatically save you money on taxes. An LLC, limited liability company, is a legal structure. It can help with liability protection. It can help separate you from the business. It can make you operate more like a real business owner, but it's not by itself a tax strategy. And that's important because a lot of people form an LLC and immediately assume they've done the tax thing. They haven't. What they've done is they've created a container. That container may eventually support tax strategy, but the container is not the tax strategy. Think about it this way. Forming an LLC is like buying a safe. It does not mean there's money in it. It just means you now have a place to put something valuable. And that's how I want you to think about your LLC. Useful? Yes. Important? Often, yes. Automatic tax savings? No. Now here's what an LLC does well. It forces you to start acting like a business owner. You get your EIN, you open your business bank account, you separate business money from personal money. That's really important. You stop pretending your side hustle is kind of a business, so you start keeping records. You start cleaning up your process. That matters because one of the biggest differences between people who stay small and people who build something real is that the ones who build something real start respecting the structure early. Not because structure is sexy. People love pulling out their iPads and mapping out these overly complex entity charts that look really impressive, but really just end up costing a whole lot of money and not adding a lot of value. But structure makes good decisions possible. So let's get to the question everyone really wants answered. How do you pay yourself from an LLC? How do you take the money from that safe and put it into your pocket in a tax advantageous way? So for most single member LLCs, that means there's one owner, usually the founder. The answer is pretty simple. You take an owner's draw. That's it. It's not a paycheck. It's not a W-2. When there's money in the operating account that you want to pull out to use for your personal expenses, you make that draw. It's important not to commingle the funds. Don't use the business debit card like your personal debit card, but you can write a check from your entity to you personally. So it's not a paycheck. It's not on payroll. It's not through a W-2, and you're not going to 1099 yourself. It's just a draw. And this is really important because when it comes to the LLC, that money that you pull out as a draw is going to show up on your personal tax return. Now, that process is pretty simple, and just because it's simple doesn't mean you should be reckless, because this is where a lot of business owners create a lot of problems. They hear you can just take a draw whenever you want. And what they translate that into is, great, every dollar in that account is mine. And technically that's correct, but it's a bad move. And it's not exactly what it means. A draw is not a magic eraser for taxes. A draw is just a movement of money. It does not change the fact that some portion of what your business earns may need to go to the IRS. The only difference is those taxes are going to get paid from your personal account. So when you pull money out of your LLC, you need to make sure that you're either pulling out enough to pay those taxes personally or leaving enough in the entity so that when tax time comes or when you need to pay your estimated payments, you've got the cash ready to do that. So if you're going to run your business this way, and in many cases you should, you need some discipline. You need a system. You need to know that just because there's money in the account, it doesn't mean it's all spendable. In fact, if you've got a growing business, you're going to need to leave even more of that money in that account to fund that growth. And you should be setting aside this money for taxes consistently, not when you feel like it, not when your accountant scares you, not in March when it's already painful enough, consistently throughout the year. That might mean that every time revenue comes in, a percentage gets moved to a separate tax savings account. That might mean you review it monthly. That might mean your number changes over time as the business shrinks or grows or does better or does worse. But the principle's the same. The IRS gets paid before your lifestyle gets upgraded. That's the smart way to do it. And I know that sounds a little bit harsh, but good. It should sound a little bit harsh. We're adults now. We're running real businesses. A lot of business owners act profitable long before they're actually managing their profit correctly. So now let's start talking about where the LLC starts to stop being enough from a tax planning standpoint, when you actually need to take some other action. There comes a point where staying in a simple LLC may not be enough. It may not be efficient. It may not be actually saving you any money. And some people out there want to issue guidelines. They want to tell you, oh, when your business is profiting $40,000 a year, $50,000 a year, or $100,000 a year, that's the best time to make maybe an S-corporation election and put yourself on salary. The reality is there's no numerical hard and fast rule. It's really a matter of whether your entity separate from you is actually generating a profit. So when I first started my law firm and I was the owner and the only employee, it was hard to make an argument that there was a reasonable salary that was different from the profit of the business because I generated all of the profit. But as the business grew and we put systems into place and we had employees running those systems, it was much easier to make the argument that I should put myself on payroll, which we're going to talk about. And that can result in pretty huge tax savings. Plus, by making the S-Corp election, in addition to putting yourself on payroll, there are now other deductions that you're able to take that you weren't able to take before. So while there's no hard and fast numerical rule on when it makes sense to set up an S-corporation or make that election, that federal tax election, through your state-created LLC, it is a good idea around $40,000 or $50,000 of profit, and as you're growing, to at least evaluate whether the time is appropriate. And notice what I said, evaluate, not blindly elect, not panic and change everything, evaluate, because you need to take a look at the tax consequences, but also the realistic cash flow consequences and administrative headaches that this may cause for your business. So there's no magic number that applies to every business in every situation, but there is a point where continuing to do nothing becomes expensive. And here's why. If you're operating as a single member LLC, a disregarded entity or a pass-through entity under the tax laws, all of your business's income is subject to self-employment tax, which means every dollar that that LLC makes is going to pay an additional percentage on top of your ordinary income tax rate. This is the, benefit of being self-employed. You pay more taxes. Congratulations. So this is on top of your income tax. And this is where people start feeling pain because suddenly it's not just their marginal tax rate they're looking at, it's the additional taxes that they have to pay. So at lower profit levels, it may not be worth adding complexity, but as the business grows and you're generating more profit, ignoring this issue can cost you real money. And this is where the S-corporation election enters the conversation. So let's clear up another confusing point. When people say, I have an LLC, they often use that as if it tells me how they're taxed, but it doesn't. It tells me the legal structure, the shell that they've put in place. It doesn't tell me the tax treatment because an LLC can remain taxed at the default way. So if you're a single member LLC, it's a pass-through, or if you're a multi-member LLC, meaning there's multiple owners or more than one partner, it could be taxed as a partnership. But in either of those cases, the business can elect to be taxed as an S-corporation. It's confusing, but the distinction matters a lot because once you elect S-corporation tax treatment, the pay yourself conversation changes. The LLC is stage 1, the S-corp election becomes stage 2. When the numbers support it. Once you have an S-corporation in place, now payroll becomes part of the picture. Now reasonable compensation becomes part of the picture. And the primary savings discussion is usually about self-employment tax exposure, not the elimination of ordinary income tax. So here's the practical progression I want you to understand. If you're early, small, inconsistent, or still figuring it out, a regular LLC with clean books and disciplined draws may be perfectly fine. But if your profits are becoming meaningful and consistent, then it may be time to ask whether an S-corp election makes sense. That's the adult version of this conversation. Not everyone needs an S-corp, and not nobody needs an S-corp. The real answer is, it depends on whether the added complexity produces enough benefit to justify it. And for the right business, many businesses, it absolutely can. So let me hit a few mistakes I see all the time. First, thinking the LLC itself saves taxes. it doesn't. Second, putting yourself on payroll when you do not actually have an S-Corp tax treatment in place. That usually creates an unnecessary mess. Third, taking draws like you won the lottery and forgetting that taxes exist. Fourth, electing S-Corp status too early just because some influencer told you that real business owners do it. That's nonsense. It often turns out that the right move is not the one that sounds sophisticated. The right move is the one that fits your numbers, your business, and your lifestyle. Fifth, electing S-Corp treatment and then failing to handle payroll and reasonable compensation properly. This is probably the biggest issue that we see when we're cleaning up messes for clients. And this is where people move from, I want to be tax efficient, to I created a compliance problem because I wanted to sound advanced. Don't do that. Be strategic, not theatrical. And that's really the theme here. Tax planning is not about sounding smart. It's about making good decisions in the right order. So if you're wondering how to pay yourself from an LLC, here's the clean summary. If you have a regular single member LLC with the default tax treatment, you usually pay yourself through owner's draws. You keep the books clean, you keep the business and the personal separate, which is also good for liability protection. You set money aside for taxes, and you don't force payroll into the picture just because you think that's what real companies do. Then as profit grows, you revisit the structure. At some point, if the numbers support it, an S-corporation election may create real tax savings. And once that happens, yes, payroll starts to matter. But not before that. That is the sequence. And when you understand that sequence, this whole topic gets a lot less confusing. So don't let the internet make this sound more mystical than it is. There's no gold dust in the LLC paperwork. There's no secret handshake. There is structure, there's discipline, there's timing, and there's knowing when the next level actually makes sense. That's it. That sounds like a lot of big steps. Why would we want to do something like this? Well, it's because the benefits can be pretty significant. So let me map this out. Here is you. Congratulations. That looks just like you. And you have decided to set up your LLC. And let's say your business is growing, it's going pretty well, and that business, without making an S-corporation election, is able to generate in profit $250,000. That wouldn't be a bad year for a new business. I'm not talking revenue, I'm talking after expenses. That's how much profit the business makes. If you have your single member LLC that has not made an S-corporation election, all of that income flows to your personal tax return. And on that $250,000 of income, you're going to pay about $76,000 of federal tax. I am oversimplifying for this example. I'm taking out the QBI deduction, which we'll do some other videos about. I'm ignoring other expenses, other opportunities. Just on its face, using the 2026 tax brackets, you're looking at about $76,000 of federal taxes. Of that, about $28,000 is what's considered self-employment or payroll tax. And the other $47,000 is your federal income tax. So on your $250,000 of income, you're going to pay $76,000 of taxes. I didn't do the math, but you're going to be left with, what is that, $174,000 after paying all of your taxes. $76,000 tax bill. Nobody should be faced with that. But let's look at this scenario where your LLC now makes an S-corporation election, and it's making that same $250,000 a year. With the S-corp, you put yourself on payroll at a reasonable salary. Now, I don't want you to lose your mind over this right now. There's calculations that go into it. You're not going to save yourself any time or any money by doing your own calculation. This is something your tax strategist, your tax advisor should be doing for you. Let me completely oversimplify it. A reasonable salary is basically, what would you pay somebody else to do this job? $80,000 per year. You're going to set up your payroll accounts. You're going to presumably have your EIN at this point. You've made your S-corporation election, and you're going to put yourself on payroll just like any other employee. But now your $80,000 of payroll income is subject to the 15.3% payroll tax. And this is comprised of, 6% for Social Security, which there's a cap on. There's a certain amount of money that you make that you're not paying Social Security tax on. And then there's additional 1.45% for Medicare. And if you add those two together and then double it, because the employee is responsible for a portion and the company is responsible for a portion, that's what gets you to the 15.3% payroll tax. But the remaining $170,000 of profit that you left in the business, again, we're talking $250,000 of income. That's $170,000 of profit, $80,000 of payroll. This remaining $170,000 is not subject to the self-employment tax. So in this scenario, your $170,000 of profit, which is not subject to the 15.3% self-employment tax, is going to save you about $26,000 per year. Pretty slick move. Now, there's a lot going on here, right? This is a reasonably profitable business at $250,000 that may or may not be an accurate salary at $80,000, but it shows you the example of the amount of tax savings here, that you're going from a $76,000 federal tax bill without the S-Corp election and without putting yourself on payroll. You're now going to reduce that by about $26,000. Now, there's one other piece here that I typically leave out of the calculation when I'm demonstrating this to people, but it's hugely important to understand when it comes time to file your taxes. For purposes of this, $26,000 of savings with a swap on the other end of a couple $1,000s of tax to offset that, this is still massive savings that we're talking about here. Now, a few other things to consider. One, like I said, this is just an example. This is an illustration. If your reasonable salary is higher than $80,000, your savings will be less because that's a higher wage that you're paying payroll taxes on. On the other hand, if your reasonable salary is lower than $80,000, let's say you're only working part-time in the business, well, then your savings would be even more significant. And this is why it's important to do this calculation correctly. Second, you need to understand that this is frequently an area that gets reviewed by the IRS. It's not a reason for an audit necessarily. They're not going to red flag you just because you've made an S corporation election, but it is an area where they catch a lot of mistakes by taxpayers. So you need to make sure your reasonable comp or your reasonable salary or your reasonable wage calculation is accurate and is something that you're reviewing on a periodic basis. You don't set this once and leave it in place forever and ever and ever. And then the third thing, like I said, is there's a little more nuance to this when it comes to the actual tax savings. But for purposes of this example, if we're talking about something slightly less than $26,000 of self-employment tax savings, yeah, we want to be having this discussion and make sure that it works. Okay, the other piece of this, fourth exception, is a lot of people want to ask when you should evaluate this. Certainly I use $250,000 of income as the example here, but I think usually around 40 or 50,000 of profit, you should be analyzing this opportunity. I'm not saying that's the threshold to make the S-Corp election, but it is the time that you want to start thinking about it. Because even at $100,000 of profit and putting yourself on payroll, let's just do the example here. If you've got $100,000 of profit and you put yourself on payroll at $80,000, that difference of $20,000 of profit that you're not paying self-employment tax on at 15.3%, that's still about $3,000. Maybe worth having the conversation at that point. Now, of course, maybe the reasonable salary is even lower, your savings would be even greater, but you also have to factor in the additional administrative headaches that you have now of filling out the payroll tax returns and making your remitting your withholding and things like that. So you got to evaluate whether it's actually worthwhile. But as the business grows, we're potentially talking about $10,000, $15,000, $20,000 of savings every year. That's why setting up the LLC and then making the S corporation election can be such a fantastic tax strategy. Actually, let's add one more thing to this too, because we're going to cover a lot of other videos on this. The fifth thing to understand is that the S Corp election, once you've made it, opens up the playbook, because now there are a whole bunch of additional tax deductions and expenses that weren't available to you when you were a single member LLC or a pass-through entity. So I use the example of you've walked into the buffet, you've made a selection, and because you've made the right selection, they now open the doors to another section of the buffet. So we can start talking about the Augusta rule and getting creative with your home office and with reimbursing expenses and with vehicles and putting your kids on payroll and so many other things that can drastically reduce your tax bill. So this self-employment tax savings through the S corporation is just the starting point.